Hello everyone, this is Tim Davis coming to you guys from the Bullish Bears team. Okay, today this video is going to be on the bull put spread. The bull put spread. So I'll be breaking down some information about the bull put spread, and I'll be using the optionsguide.com to show you guys where you can go to get some of this information. And then I'll show you guys an example and show you some of its advantages and disadvantages. Alright, so the bull put spread. The bull put spread option trading strategy is employed when the options trader thinks that the price of the underlying asset will go up moderately in the near term. The bull put spread option strategy is also known as the bull credit spread, as a credit is received upon entering the trade. And the way it's normally constructed is by buying one out of the money put and selling one in the money put at a higher strike price. So the bull put spreads can be implemented by selling the higher striking in the money put option and buying a lower striking out of the money put option on the same underlying stock with the same expiration. And for those of you guys who don't know about the optionsguide.com, is a very good resource for you guys to go to if you wanted to see some written information to try to get a better understanding of some of the different option strategies. Okay, one of the disadvantages has limited upside potential with this strategy, but you will minimize your exposure or your risk at the same token. If the stock price closes above the high strike price and on expiration date, both options will expire worthless, and the bull put spread option strategy earns the maximum profit, which is equal to the credit taken in when entering the position. So you can read the rest of this at your leisure. I'm going to get straight to some examples. I'm going to show you what it looks like in ThinkorSwim as well, so you can understand what the risks look like, what your profit potential looks like, and the collateral you need or the buying power you need in order to get in some of these trades and how you can adjust that. So I'm going to go over to ThinkorSwim. I already have one set up here, but I'm going to show you guys how you can get to this trade. So for this example, we're going to use Facebook. Alright, so today is April the 7th, 2019 right now. Today is a Sunday, and Friday looks like Facebook closed at around 175.72. So Facebook closed at 175.72. So if you're inclined to believe that Facebook stock will continue to rise over a certain amount of time or not go too far, you can put on a bull put spread and taking a credit versus either buying the stock outright or buying a vertical call spread. And another thing about these put spreads, these bull put spreads, you can actually put probabilities in your favor, and I'm going to show you what I mean by that. So right now the current price of the stock is trading at 175.72. So what we want to do is we want to end up selling or getting the bull put spread below price action, and as long as price action stays above the strikes that you sell, you can you can receive a profit or keep the credit received for this particular trade. So you can be profitable as long as price stays above your bull put spread that you set up. So the way it looks, and for this example, we're going to use, and I'm gonna move these strikes around so you guys can see some of the different calls, the different credits that you'll get, things like that, so you can see how it changes when you move the strikes around. So for this example, we're going to buy, and instead of going in the money, we want to keep these out of the money. I'm going to show you guys the difference. Then I'm going to do one with buying one in the with selling one in the money, and I'm going to show you guys the advantages of selling one out of the money. So this one right here, we're going to sell one out of the money. So we're going to keep the one that you sell out of the money close to the last price of the stock. Okay, so for this example, I'm going to sell the 172.50. Then I'll go further out of the money and buy buy one, and that helps you set it up as a credit where you can get a credit, and it also is going to put you in a position to limit your exposure as well by buying one further out of the money. All right, so now if once you set that up, and the way you can set that up in ThinkorSwim is pretty much what I just did. I'll show you guys it again. So I'm actually going to sell the 172.50s and I want to buy the 170 puts. So you come over here on the put side and click on the bid section, and right where it says 170, 172, and voila, your order pops up. If you click on confirm and send, you don't want to send it if you're not ready to do the trade. Here on ThinkorSwim, it breaks it down for you, shows you what your max profit, shows you what your max loss is, and it also shows you what your break-even points are. All right, and tells you what your buying power effect is. So you would need to at least have $198.45. That is your buying power effect. Okay. Now the credit that you're going to take in which is $60. Okay. So $60 to put on this trade, and you get to keep that $60 as long as you stay above the long strike price. Now, a lot of people look at this and say my max loss is 190. Well, because that's your buying power effect. You got to have a certain amount of buying power effect, and yes, that could be your max loss if you fall below the shorter strike that you purchase. Now, a lot of people might look at that and like it might be a little, might be a little iffy or a little afraid to take on this, to take this trade. But let me show you some probabilities. And what I'm gonna do first of all is I'm gonna show you guys what probabilities look like on a single option. So the one that we're selling, the one that we're buying is a 172.50, and we're going to buy the 170. So what I want to do for the purposes of this example is go to the single puts first. All right, so let's say if we was to buy a single put and we think the price with action was going to drop, or if you just sell a single put or buy a single put. So if you was to buy a put at the 172.50 strike, over here I got down what your probability of this stock being of this put being out of the money. So if you was to just buy 172.50 put, what you'll see is that the probability of that particular put being out of the money is 66.88%. That's what you want. You want probabilities in your favor. So if you sold this put, okay, that means you can take a credit. And when you sell a put, you know what I'm saying, that's below the price of the stock, what you want to see is that expire worthless, because that means you can take in the full credit. Okay, so you're putting probabilities in your favor. So that 66.88% chance of this particular put being out of the money is what you want. Okay, so you put in probabilities in your favor when you sell and taking in that credit, because as long as it expires out of the money, you'll get the chance to keep that credit. And as you go further up the chain, as you can see how the probabilities change. So the probability of this 160 strike being out of the money is even higher, 95.78%. So if you just sell it, you'd be able to take in 14 cents of credit. As you can see, that's what the bid price is. Okay, now if it was to go against you and you just sold a naked put, that's where the problem lies. That's when you can get into some trouble. So looking at these probabilities, so you put in probabilities in your favor when you are selling a put to take in credit. Now if you set it, now when we set it up, it's a vertical spread, okay, you're limiting your exposure, because if you just did a single, you sold this 172.50, saying the price is going to stay above, but what if it doesn't? What if it doesn't? What if it goes against you? Look at your max loss now, $17,098. So that's why putting it in a credit spread works a lot better. Even if it goes against you, you can profit, and I'm going to show you guys that. All right, so let's go back to vertical spreads now, and we're going to set up this that 170, 172.50. So you see how probabilities be in your favor when you're selling, and I'm taking in a credit. So firm is sent again. So now your max loss is only 190. So some people might be still, well, why would I do that? Well, let me show you why would you do this. So let's go to the Analyze tab. Point out a couple things. So two things that work in your favor when you're doing a bull put spread. You got to keep this in mind. That a bull put spread profits from time decay or the rising in the price of the stock, or both. So you put in time decay in your favor. So as time continuously go on, you know what I'm saying, you're taking in a credit. So as time decay goes on, you're receiving a credit for you know, the price of the underlying stock remaining above your strikes. And also, as price continue to rise, you also will profit from that way as well. So you can profit from both time decay and rising price of the stock, rising stock price. All right, so let's analyze this trade real quick. So as you can see, 172.50 is right around here. Okay, and this expiration I'm using for this one is April 18th. So as long as the price continuously stay above that 172.50, you will be able to collect and receive the full profit at expiration. All right. Well, what if for some reason at expiration, you know, it drops and it goes down to 172? So let's see what happens. 172, right about there. So 172 at expiration. Look over to the left-hand side of my screen, all the way at the bottom. Ignore the purple sign where it's, the purple date where it says 4719. Look at the blue date below that where it says 41919. Okay, and I have my cursor right on 172.05. So if this stock drops to 172.05 and it stays there at expiration on the 18th, you will still receive $15.36 credit. So you will still profit from this trade, even though you drop below the 172.50 strike. So you guys see how that? See, and now take it a little further. So if you go down to, and that's another thing. This bull push spread, it puts you in a position where you have time to react and close this trade out or adjust it if you drop below your long strike. Okay, so the minute you drop below 172.50, you got time to decide whether or not you're going to stay in the trade or you're going to close it out, so that you won't receive max loss when you reach 170. Okay, understand that? So now, so keep that in mind. Stay above 172, you more than likely stand a chance to get some kind of profit. If you look at the charts now, price action is at 175.72. So you give yourself a lot of cushion for error. And that's the one powerful thing about setting up bull put spreads. It all depends on where you set your strikes at. You're leaving yourself room for error, which makes this so much more powerful than just buying a straight call for this price to rise, because you don't really have to, you know, sit back and wonder if it's going to rise or not. And all you concerned about is price staying above your long strike. All right. So again, price stays above or around 172.50, you'll profit. If price starts to fall towards that 172.50, you can always close out the trade and readjust it and go lower if that's what you need to do. So here you're giving yourself a lot of room. This is on a 1 hour. So I give yourself a lot of room. So price drops all the way down here to 172, and it's right now it's above the 20 EMA. So you got a lot of room between where it is now and down to 172. So you got a lot of room to play with. Okay, so as long as that price stays above that 172.50, you can take in that $60 credit. So now again, that puts probability of you being successful in your favor. Okay, so you have a lot of room to play with again to get out of this trade so that you will not receive maximum loss of 170. Okay, so that's what makes it so powerful. You can adjust this trade at any time. Okay, so the chances of you receiving max loss is very, very small if you adjust and monitor your trade properly. Okay, but you have a high probability being able to keep that credit, which makes this a very, very good income receiving strategy. You can do this week in and week out and constantly collect credit from putting on these bull put spreads. Okay, so if you believe price is going to stay neutral or it's going to rise, put on bull put spreads. Okay, for profit, and as long as you continue to stay above that long strike, you will always receive a profit. And as you can see, the probability of you touching this long strike up here, and I got this on touching up here, probability of you touching this long strike, 99.60%. 99.60%. I'm sorry, not the long strike, but your break-even point or max profit point, which is max profit point is a little bit below that, but your break-even point where we set the slices. So your probability of touching 175.74 is 99%. As you can see, 99%. And that's what you want to see. You want to see, you know, as you know, this stock continues to move between now and expiration. You want to see what your probabilities are. So you have a probability of 99% of this stock closing at 175.74 at expiration, which means you get to keep your full profit. Now, what are the chances of you? Let's look at the probability if you start to fall below 172. So the probability if you fall at 170, price closes at 170, 61.24%. So still, you got probabilities in your favor. So it's a high probability of this price action actually touching 175.77. You can close this trade out early. You know what I'm saying? So if the price starts to rise, you know, you can close this trade out early and collect your profits. All right. All right, folks, that is my spiel on the bull put spread. Why I think it's so powerful. Easy way to generate income on a weekly basis, especially with stocks, big money stocks that have weekly contracts that are very liquid. You can use these put spreads to take advantage of receiving credit day in and day out, and you can play with it by moving your strikes around. Whereas you feel more comfortable that you have a better chance of being profitable. All right, so that is my spill on bull put spreads. Hopefully this information was something that you can use. Until the next video, this is Tim Davis from the Bullish Bears team signing off.